The house you dream about might be the exact reason you never get rich. Let that sink in for a second. We grow up with this picture in our heads: the cute house, the yard, the keys in your hand, and everyone saying, "You've made it." But what if, for a lot of middle-class families, buying that house is actually the moment they quietly lock themselves out of real wealth, and the renter down the street ends up richer than they are? Hi, I'm Jazz. I have a master's in finance, and I'm here to help you out to make better financial decisions through my video. Today, we're going to blow up the automatic assumption that buying is always better than renting and walk through a brutally honest side-by-side story. Lisa the renter versus Dave the proud homeowner. Same income, same city, same starting point. 20 years later, one of them has the dream house and a stressful bank balance, and the other has the freedom to never worry about money again. Let's start with the myth. You've heard it a million times. Renting is throwing money away. At least when you own, you're building equity. It sounds smart, it feels responsible, and honestly, it's emotionally satisfying. You turn a key in a door that's yours. You can paint the walls. You can say you're not wasting money on rent. Family members clap. Instagram loves it. But here's the uncomfortable truth. A lot of homeowners are not building wealth. They're just redirecting their money from obvious expenses to invisible ones. The middle class has been sold a set of rules like own your home as soon as possible, and a paid-off house is the ultimate security. Yet many of those same people end up house poor, cash-strapped, stressed, and years behind on investing. Why? Because they fell for the ownership illusion. The ownership illusion is the feeling that because your name is on the title, you own an asset. In reality, the bank, the tax office, the HOA, and the endless list of contractors all have a claim on your cash before you see a cent of that so-called wealth. Here's what homeownership really looks like for millions of people. You don't just have a mortgage, you have property taxes that can easily be 1 to 2% of the home's value every single year. Home insurance, sometimes private mortgage insurance on top of that. HOA fees if you live in a community or condo. Closing costs when you buy, thousands to tens of thousands up front. And then the big one people forget, maintenance and repairs, often 1 to 3% of the home's value per year on average over time. On a $350,000 home, 1 to 3% in maintenance alone is $3,500 to $10,500 per year. That's $300 to almost $900 a month, and that's before we talk about taxes, insurance, and surprise repairs. So when someone says, "My mortgage is only $1,800, that's just like rent. They're leaving out the extra $600, $800, $1,000 a month quietly bleeding out through everything attached to that cheap mortgage. Now let me introduce you to Lisa and Dave. Lisa and Dave are both in their early 30s. Same city, same income, similar lifestyles. Let's say they both bring in enough to afford a decent place in an average cost city. Dave does what everyone expects. He buys a $350,000 home. His 20% down payment is $70,000. He scrapes together the savings, empties his account more than he's comfortable with, and pays another chunk in closing costs, things like inspection, appraisal, title fees, legal fees. By the time he gets the keys, he's down maybe $80,000 to $85,000 in cash. Lisa, on the other hand, decides to rent a nice apartment for $1,800 per month. She could buy. People tell her she's throwing money away, but she runs the numbers. Here's where it gets interesting. Dave's mortgage payment might be around, for example, $1,900 to $2,000 a month, depending on rates and taxes. Add in property taxes, home insurance, maybe HOA fees, an average maintenance and repair budget, and suddenly his true monthly cost of owning, when you spread everything over the year, is not $2,000, it might be closer to $2,400 or more. Some months it looks fine, and then the water heater dies, the roof leaks, the AC needs work, and an average year turns into a highly expensive one. Lisa is paying $1,800 in rent. She doesn't pay property tax. She doesn't have to replace the roof. The air conditioner dies? That's the landlord's problem, not hers. Let's say when you add utilities and renter's insurance, her total housing cost still comes in a few $100s below Dave's true ownership cost. Here's the key move. Lisa doesn't just pocket that difference and blow it. She invests it. Let's say the gap between Lisa's rent and Dave's total true monthly cost of owning is $600. Lisa sets up an automatic transfer. $600 a month goes straight into a low-cost index fund inside a brokerage or retirement account. Every month. No excuses. On top of that, remember the down payment? Dave had to sink $70,000 into the house, plus closing costs, which might be another big chunk. Lisa keeps that same amount invested in the market instead of burying it in a single property. Now we run the 20-year simulation. This is where most people's intuition breaks. They assume, well, houses always go up, so surely Dave ends up ahead. Not necessarily. Case 1, the normal world. Let's assume the house appreciates at a modest rate over time, say 3 to 4% per year. The stock market historically returns something like 7 to 10% per year on average over long periods. 20 years later, Dave has built equity in his home. He's paid down a big chunk of the mortgage, and the home is worth more than he bought it for. On paper, his net worth looks good. The dream did work, sort of, but Lisa? She has 2 decades of consistent $600 monthly investments compounding in the market. The original down payment sum that she invested instead of tying up in the house also compounding. Depending on the exact returns, it is extremely common in modeling for Lisa, the disciplined renter/investor, to end up with a higher net worth than Dave. Not because renting is magical, but because investing the difference at higher long-term returns is powerful. In many real scenarios, especially in expensive cities where home prices and costs are bloated relative to rents, Lisa wins. Case 2. The hot housing world. Now suppose home prices rip higher for a decade. Dave looks like a genius. His home equity explodes. But remember, he's also paying higher taxes, higher insurance, higher maintenance costs on a more expensive asset. And he's concentrated. Most of his net worth is in one property in one city. Lisa's rent may rise, yes. But as long as the gap between renting and owning remains, she continues to invest the difference. Her stock portfolio grows across thousands of companies around the world. She has diversification and liquidity. In many of these scenarios, even if Dave's house does well, Lisa's balanced portfolio plus her flexibility give her a serious shot at matching or beating his net worth. Case 3, the bad timing world. This is the one nobody wants to talk about, but it happens. Dave buys near a peak. A few years later, home prices in his area stagnate or fall. He's stuck. The house ties him down. Moving is expensive. Selling is expensive. He might not be able to sell without taking a hit after fees. Meanwhile, all those costs, taxes, insurance, maintenance, keep marching on. Lisa, if she hates her neighborhood, moves at the end of her lease. No 6% realtor fee. No closing nightmare. Her investments are still working for her in the market, independent of one specific zip code. None of this means never buy a house. What it does mean is that home ownership is not automatically the golden ticket you've been sold. Renting is not automatically throwing money away, especially if you're actually investing the money you free up. Here's the real question. Are you using your housing decision to maximize status or to maximize net worth? Let's go back to Lisa and Dave, year by year. In the first 5 years, Dave is proud. Friends praise him. You bought a house? That's amazing. You're so responsible. He posts house pictures, the yard, the renovations. It feels great. Financially, though, he's stretched. Between his mortgage, all the extras, and the random oh no repairs, there's not a lot left at the end of the month. Retirement investing is minimal or inconsistent. Lisa gets the opposite reaction. People tell her she should stop throwing money away on rent. Parents hint she's behind in life. She doesn't look rich, but she's investing consistently. Every single month, that $600 is buying pieces of companies all over the world. Dividends are being reinvested. Her down payment-sized investment is quietly compounding as well. At year 10, Dave starts to feel the wear and tear of his 10-year-old house. Systems need updating. That deck he loved needs work. Insurance is up. Property taxes have crept higher. His house has appreciated, but he can't spend appreciation without selling or borrowing. On paper, he's wealthier. In cash flow terms, he's tight. Lisa at year 10 might still be renting, maybe in a better place, maybe even in a cheaper area because she has flexibility. Her investment accounts, though, are starting to take off. The magic of compounding begins to become visible. She's not rich yet, but for the first time, she clearly sees her net worth moving because of her investments, not just her labor. By year 20, the story flips. Dave has a lot of his wealth tied up in one house. It's valuable, yes, but if he wants to use that value, he has to either sell and pay fees and then figure out where to live, or borrow against it and take on more debt. His retirement accounts may be smaller than they could have been because for 20 years, housing soaked up a big portion of his extra cash. He won the dream, but it came at a cost. Lisa, if she stuck to the plan, has 20 years of stacked investments from that monthly $600. 20 years of growth on the original chunk that Dave put into the house. A portfolio she can tap, reallocate, and live off without having to beg a bank. In plenty of real-world scenarios, she ends up with more liquid wealth than Dave, not house status, actual usable money. Now, to be completely fair, buying can absolutely be a great move in certain conditions. Cheap prices, reasonable costs, staying put for a long time, buying less than you can afford, and still aggressively investing on top of your housing, that can work beautifully. Owning your home outright later in life can feel amazing. But that's not how most people do it. Most people stretch to the top of what the bank will approve, become house poor, and then tell themselves it's okay because real estate always goes up. They follow middle-class money rules that sound safe, but quietly block them from ever letting their capital grow where it might grow faster. So instead of asking, is renting better than buying? Switch the question, am I investing the difference? If you rent a place that costs less than owning and you just spend the extra money on restaurants and gadgets, then yes, renting might keep you broke. But if you rent strategically, lower fixed costs, higher investing rate, you can absolutely come out ahead. On the flip side, if you buy a home but it forces you to pause investing for 5 years, drags your cash flow, and leaves you with no margin for emergencies, that asset might actually be slowing down your path to wealth. So how do you actually decide what's right for you? Let's quickly build a simple rent versus buy framework you can use. Here's the mental calculator. 1. Total monthly cost of owning. Don't just look at the mortgage. Add mortgage principal and interest. Property taxes. Homeowner's insurance. HOA fees if any. An average monthly amount for maintenance and repairs. Take 1 to 3% of the home's value per year and divide by 12. That final number is your real monthly cost of owning. 2. Total monthly cost of renting. Take rent plus renter's insurance plus the utilities you'd pay that aren't included. That's your real monthly cost of renting. 3. The difference. Subtract the renting cost from the owning cost. Is owning actually more expensive each month? By how much? If renting is cheaper by $600, that's your invest the difference number. If owning is somehow cheaper in your case, great, that may flip the analysis. 4. Opportunity cost of the down payment. Ask, what would this down payment be worth if I invested it for 10 to 20 years? That opportunity cost is massive and often ignored. 5. Time horizon and flexibility. How long are you realistically going to stay? If it's only a few years, transaction costs alone can eat a big chunk of any appreciation. If it's 10 to 20 years and you buy conservatively, owning might shine if you still invest on top. 6. Your behavior. Can you actually be Lisa? Will you truly set up an automatic monthly investment for the difference and leave it alone? Will you avoid lifestyle creep because, hey, rent is cheaper? The math only works if your behavior cooperates. Once you run through that framework, you stop thinking in black and white. Rent bad, own good. Instead, you start seeing housing as one piece of a much bigger wealth strategy. Buying can make you rich. Renting can make you rich. Buying can keep you broke. Renting can keep you broke. The real dividing line is whether you tie up all your money in a house or whether you give your investments a chance to grow. So the next time someone tells you you're just throwing money away on rent, you can smile and think, Actually, I'm buying my freedom in index funds every single month. And if you already own a home and you're feeling called out right now, don't panic. The point isn't to regret your decision, it's to stop the damage. Cut the lifestyle bloat, lower unnecessary housing costs if you can, and get serious about investing outside your house. Homeownership does not have to be your prison, but it also doesn't automatically make you rich. The question is not, should I rent or buy? The question is, am I investing the difference? If this video helped you see the homeownership myth a little more clearly, make sure you subscribe, share this with someone who's obsessing over buying a house right now, and drop a comment telling me where you stand. Team Lisa, Team Dave, or somewhere in between. And if you want a follow-up video where we plug your numbers into a real rent versus buy calculator, let me know below. Because the goal isn't to win the Instagram game of who has the nicer house. The goal is to win the quiet game of who actually has the freedom to live life on their own terms.